All right, let's talk about market crashes. We're going to completely flip the script on them today. I want to show you how to stop seeing these moments as pure fear and start seeing them for what they really are. Maybe the single greatest opportunity you'll ever have to build real wealth. I mean, just let that sink in for a second. We're all wired the same way, right? You see that sea of red on your screen and your stomach just drops. It's panic. But what if that feeling is wrong? What if all that red is actually a giant everything must go sales sign plastered on the world's best assets?
Yeah, you heard that right. Market crashes, they aren't a bug, they're a feature. It's not a sign that the whole system is broken. It's actually a natural, totally normal part of how markets work. They kind of, clear out the junk, get rid of the excesses, and set the stage for the next big wave of growth.
And look, this is nothing new, not by a long shot. Just take a look at this timeline. We're talking the Great Crash back in 29, the dot-com bubble, the 2008 crisis, all the way to the COVID crash in 2020. These things are a constant recurring feature. It's almost like a rite of passage for every single generation of investors.
And the sheer scale of these drops, it can be absolutely mind-blowing. Just try to imagine your entire portfolio gone. Poof. During the Great Depression, the stock market lost, get this, over 80% of its value from top to bottom.
Or, hey, something maybe a little more recent. Remember 2008, the global financial crisis? That thing reshaped our entire economy, and it just wiped out 54% of the S&P 500's value. Just like that.
And it's not just the market as a whole. Even the giants, the companies you think are invincible, they're not immune. Case in point. After the dot-com bubble burst, Amazon stock, a company we all know, plummeted by a jaw-dropping 90%.
Okay, so we know markets eventually come back. That's the good news. But here's the real kicker. How long does it really take to recover? Because I'm telling you, the number you see on your brokerage statement, it might be lying to you.
And this right here, this is a super important distinction. You've got two kinds of recovery. There's nominal recovery, which just means you got your dollars back. The number is the same. But then there's real recovery, and that means you got your purchasing power back. Think about it. If it takes 5-10 years to get your money back, inflation has been chewing away at the value of those dollars the entire time.
Okay, so this chart is where the rubber really meets the road. This puts numbers to that hidden cost I'm talking about. Just look at the dot-com bust in 2000. It took about 7 years to get your nominal dollars back, right? But because of inflation, it took almost 15 years to get your actual buying power back. That's an extra 8 years. 8 more years just to get back to even.
So picture this. Your portfolio's down 25, 30%, maybe more. You're officially at a crossroads. And believe me, the choice you make right here, in this moment of panic, it can completely change the course of your financial future.
So what are your options? Well, you've basically got 3 paths you can take. Path number 1, the dash for cash. You sell everything, you run for the hills. Path 2, stay the course. You just grit your teeth, hold on, and wait for it to be over. And then there's path number 3, double down. You actually start systematically investing more money.
Let's talk about that first path, the dash for cash. You know the voice in your head, right? It's screaming, "Get me out now! I just need to stop the bleeding!" It's a totally primal emotional reaction. The pain of losing money feels so real that your only goal is to just make it stop. So, which path actually works out? Well, the data doesn't lie. Let's look at the numbers from that 2001 dot-com crash. If you just stayed invested, your recovery took about 5.5 years. Not bad. If you actually invested more, you recovered in just 4.5 years. Even better. But that dash-to-cash strategy? That was by far the worst move. You sell in a panic, you try to time getting back in, you miss the biggest rebound days, and you just end up cementing your losses.
And that brings us to that amazing third path, doubling down. This is where we completely flip the script. Instead of being terrified of the fall, we're going to learn to see it for what it is, a generational buying opportunity. It's like a massive 50% off sale on the best companies in the world.
So, what are we hunting for? The key is to look for something called bruised blue chips. Now, these aren't failing, dying companies. Not at all. These are strong, dominant, profitable businesses that just got beaten down by a market-wide panic. The underlying business is perfectly fine. It's just the stock price that's got a black eye.
And wow, this table just perfectly illustrates the power of this idea. Check out these survivors from the dot-com apocalypse. Amazon, down 90%. Nvidia, down 84%. At the time, everyone thought these companies were headed for zero. But they were fundamentally solid businesses, and they didn't just survive the carnage, they went on to basically define the next 2 decades of our economy.
You know, the truly legendary investors have this playbook memorized. Think about Warren Buffett. At the absolute peak of the 2008 panic, when everyone else was running for their lives, he calmly invested $5 billion into Goldman Sachs. He gave them cash when no one else would, and in return, he got the deal of a lifetime that made his company, Berkshire Hathaway, billions. He didn't run from the fire. He ran towards it.
Okay, so you're probably thinking, that's great for Warren Buffett, but I don't have billions of dollars. And you're right. You don't need it. What you need is a system. The key is to rely on simple rules, not your own emotional willpower. Because I promise you, when things get crazy, your willpower will completely abandon you.
First things first, forget about timing the market. Just get that idea out of your head. Nobody, and I mean nobody, can consistently predict the exact bottom. It's not about timing the market, it's about your time in the market. And the stats on this are shocking. If you miss just the 10 best days of a recovery, you can slash your long-term returns almost in half. And guess when those best days happen? Yep, when the fear is still absolutely off the charts.
So what's the #1 tool in your playbook? It's something called dollar cost averaging, or DCA. It's super simple. You just invest a fixed amount of money at regular intervals, say every month. This totally takes emotion out of the game. It's automatic. You end up buying more shares when prices are low and fewer shares when prices are high, without even thinking about it.
But wait, you can even take this to the next level. You can supercharge it with what I call a booster DCA strategy. Here's how it works. You set up rules ahead of time. So your normal monthly investment goes in, but if the market drops, say 20%, boom, a bigger chunk of money from your cash reserves gets invested. If it drops 30 or 40%, boom, an even bigger chunk goes in. You're systematically leaning into the panic, not away from it.
All right, finally, let's wrap this up with your antidote to panic kit. 3 simple things. Number 1, build a cash bridge. That means having 18 to 24 months of living expenses sitting in cash. Why? So you are never a forced seller at the absolute worst time. 2, automate everything. Set up those automatic DCA contributions to enforce that discipline. And 3, rebalance once a year. This forces you to sell a little bit of what's done well and buy a little of what's done poorly. It's a built-in buy low, sell high machine. When you really boil it all down, it comes to this. That gut-wrenching, stomach-churning feeling you get during a crash, that volatility, that's not the risk. You know what it is? It's the price of admission. It's the cost of the ticket you have to pay to get those superior long-term returns.
Because let's be crystal clear, the next crash is coming. It's not a matter of if, it's a matter of when. So the only real question you need to ask yourself is this. When it arrives, are you going to see a catastrophe? Or are you going to be ready to find your fortune in the fall?